In the bustling heart of Lower Manhattan, where the dreams of capitalism dance with the nightmares of regulation, a new chapter in America's financial story is unfolding. It's a tale of caution, innovation, and the relentless pursuit of stability in a world that seems increasingly unstable. Picture, if you will, the Federal Reserve Bank of New York, that imposing limestone fortress on Liberty Street. Within its walls, a decision has been made that could shape the financial landscape for years to come. John Williams, the bank's president and a man whose words can move markets, has announced the formation of a new committee with a name that would make any bureaucrat proud: the Reference Rate Use Committee. Now, I know what you're thinking. David, you say, why should I care about some wonky committee with a name that sounds like it was created by throwing Scrabble tiles at a wall? Well, dear reader, let me tell you a story that begins with a scandal, winds through the corridors of power, and ends with a promise of a more stable financial future, or so we hope. Cast your mind back to 2008, a year that still sends shivers down the spines of bankers and homeowners alike. As the global financial crisis unfolded, a sinister secret came to light. LIBOR, the London interbank offered rate, a benchmark interest rate that underpinned trillions of dollars in financial contracts, was being manipulated by the very banks entrusted to set it. This wasn't just some arcane financial chicanery. LIBOR affected everything from mortgages to student loans, from complex derivatives to your grandmother's savings account. It was the pulse of the global financial system, and it was irregular. The fallout was catastrophic. Trust, that most fragile of financial commodities, evaporated like morning dew in the harsh light of scandal. Billions in fines were levied, careers were ruined, and the financial world was left scrambling for a solution. Enter SOFR, the Secured Overnight Financing Rate, a new benchmark created to replace the tainted LIBOR. SOFR was supposed to be the knight in shining armor, rescuing the financial markets from the dragons of manipulation and mistrust. But like all heroes, SOFR has its flaws. Which brings us back to John Williams and his new committee. This isn't just about replacing one acronym with another. It's about learning from the mistakes of the past and building a financial system that can withstand the storms of the future. The LIBOR saga taught us all two important lessons, Williams said, his words echoing through the conference hall. First, enormous systemic risk can build in the global financial system gradually over time, and second, it took a complex, expensive, decade-long effort to fix that problem. We must not repeat that experience. These are not just the musings of a central banker. They are a call to arms, a recognition that the financial system, for all its complexity and sophistication, is still vulnerable to human frailty and greed. The Reference Rate Use Committee, set to begin its work in October, will be chaired by Patrick Howard, Deputy Chief Risk Officer of Morgan Stanley. It's a fitting choice, bringing together the watchful eye of the Fed and the practical experience of Wall Street. But what exactly will this committee do? According to Williams, it will focus on key issues regarding reference rates, including how their use is evolving and how the markets underpinning them may be changing too. In other words, it will be a financial early warning system, scanning the horizon for the next LIBOR-like iceberg before we hit it. The committee will also promote best practices related to the use of reference rates. This is bureaucrat speak for making sure everyone plays by the rules. It's a noble goal, but as we've seen time and time again, rules are only as good as the people enforcing them. And here's where things get interesting. The New York Fed has proposed modifications to how SOFR is calculated. It's a recognition that the financial markets are not static, that they evolve and change like living organisms. What worked in 2018 when SOFR was introduced may not be sufficient in 2023 and beyond. But SOFR, for all its improvements over LIBOR, is not perfect. It lacks two key features that made LIBOR so useful and, ultimately, so dangerous: a forward-looking curve and a credit component. These might sound like technical details, but they're crucial for how banks and businesses make decisions about lending and borrowing. So, we find ourselves at a crossroads. On one side, we have the lessons of the LIBOR scandal, a stark reminder of what can go wrong when we place too much trust in a single benchmark. On the other, we have the promise of SOFR and the vigilance of this new committee, a hope that we can build a more robust and transparent financial system. But let's take a step back and consider the bigger picture. What does all this mean for the average American? For the small business owner in Omaha, the teacher in Atlanta, or the retiree in Phoenix? On the surface, it might seem like nothing more than financial inside baseball. But these reference rates, these obscure benchmarks, are the invisible threads that weave through the fabric of our economic lives. They influence the interest rate on your mortgage, the returns on your pension fund, the cost of borrowing for your local government to build a new school. In a way, this new committee is like a group of doctors monitoring the heartbeat of the economy. They're checking its pulse, listening for irregularities, ready to raise the alarm if something doesn't sound right. And just like your annual checkup, it's not something you think about every day, but you're glad someone's doing it. But there's a deeper story here, one that goes beyond interest rates and financial regulations. It's a story about trust, about the delicate balance between innovation and stability, about the never-ending quest to build a financial system that serves the many, not just the few. In the wake of the 2008 crisis, there was a lot of talk about reforming Wall Street, about making sure such a catastrophe could never happen again. And while progress has been made, the formation of this new committee is an admission that the work is never really done. It's also a reminder of the central role that New York, and by extension America, plays in the global financial system. When John Williams speaks, the world listens. When a new committee is formed in Lower Manhattan, it has implications from London to Tokyo, from Frankfurt to Shanghai. But as we look to the future, we must also reckon with the challenges that lie ahead. The financial world is changing at a dizzying pace. Cryptocurrencies, artificial intelligence, climate finance, these are just a few of the forces reshaping the landscape. How will our reference rates, our regulatory frameworks, our very concept of money need to evolve to keep up? And what of the human element? For all our sophisticated models and complex algorithms, finance is still, at its core, a human endeavor. It's built on relationships, on trust, on the belief that when you deposit your paycheck or take out a loan, the system will work as it should. The Reference Rate Use Committee, with its dry name and technical mandate, is really about rebuilding and maintaining that trust. It's about creating a financial system that is not just efficient, but fair. Not just profitable, but sustainable. Not just powerful, but accountable. As I write this, looking out over the canyons of Lower Manhattan, I'm struck by the contrast between the timeless architecture of the Federal Reserve Building and the ever-changing skyline around it. It's a fitting metaphor for the challenge we face. How to build financial institutions that are both rock-solid and flexible enough to adapt to a rapidly changing world. The formation of this new committee is not the end of the story. It's not even the beginning of the end. But perhaps, to borrow a phrase from Churchill, it is the end of the beginning. The beginning of a new era in financial oversight, one that learns from the mistakes of the past and looks clear-eyed toward the future. As we move forward, we would do well to remember the words of John Williams. We must not repeat that experience. The LIBOR scandal was a wake-up call, a reminder of the enormous responsibility that comes with managing a global financial system. This new committee is our collective response, a promise to do better, to be better. But promises are easy to make and hard to keep. The real test will come in the years ahead, as this committee grapples with new challenges, unforeseen crises, and the ever-present temptation to put short-term gain ahead of long-term stability. For now, though, we can take some comfort in knowing that there are those who are watching, who are working to ensure that the foundation of our financial system remains strong. It may not be glamorous work, but it is vital. And in these uncertain times, that's something worth celebrating. As I finish writing this column, the sun is setting over the Hudson, casting a golden glow over the city. The traders have gone home, the markets have closed, but the work of building a better financial future continues. And tomorrow, when the markets open again, we'll be one step closer to that goal, thanks to a group of dedicated individuals meeting in a room in Lower Manhattan, keeping watch over the heartbeat of our economy. In the end, that's what this story is really about. It's not just about interest rates or regulatory committees. It's about us, our hopes, our dreams, our shared future. It's about building a financial system that works for everyone, that can weather the storms of tomorrow while learning from the mistakes of yesterday. And so, as we look to the future, let us do so with cautious optimism. Let us remember that while the challenges are great, so too is our capacity for innovation, for adaptation, for progress. The formation of the Reference Rate Use Committee may seem like a small step, but it is a step in the right direction. And in the grand journey of building a better financial future, every step counts.